Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. Is the market headed for a massive crash? Henrik Zeberg joined Wealthion this week and thinks it could be. He questioned why the Fed has not yet cut rates and hinted that we could be facing a banking and pension crisis.
And why do you think the Fed is taking so long to cut, especially with weakening economy? And when we look at the Q1 GDP numbers, I believe the first number came in at 1.6%, and this is down from last year when it was growing at 3%, but it was revised down to 1.3%. And it does look like the economy is slowing. But why do you think the Fed is taking so long to make a decision here?
Honestly, I think they're looking at the wrong numbers, and we know that they have an inflation as part of their mandate that they need to keep the inflation low, but the inflation is a lagging indicator on the or lagging parameter on the economy. So it's like looking out the rear window when you're driving forwards in your car. So you're looking out the rear window, and then you will discover later what actually it is that you go by when you drive forward. So that is what is happening to the Fed here. That's why they'll be hopelessly late again this time around, like they've been so many times before, both in terms of when they need to cut and when they need to hike. And so they are way past the time where they should have started cutting rates. So we have unemployment moving up now. We have most recent retail sales also seeming to be showing a slowdown in the economy and so on. There are many signals now, and in my models they are way too late. So I think they have been afraid of what they unleashed, or what they think they unleashed in terms of the inflation the last time around. And that's why they're kind of sitting on their hands now, saying, "Oh, we definitely do not want to trigger inflation because that's going to hurt the consumers." But the other thing is also a bad thing, and that's what they are up to doing right now, honestly. And again, it will come no matter what. And the last phase, just getting back to your previous question, also the last phase of when the Fed, not when they cut, but actually the moment up to that first cut, is where we normally see that the markets really take off. And that's why we've seen that take off now. My timeline has then shifted a bit, and that is that I had to say, well, of course, when we got to, was it March or April, I said, well, you cannot reach these numbers by June, but it seems like now the September timeline is more realistic in terms of when we'll see the top in the stock market and in the crypto market, and also and then a recession potentially setting in like in Q4 of this year.
Henrik, you made an interesting comment about the ECB and that they recently cut rates, and they did so with the inflation still relatively high, and they made mention of that fact too. But I guess the threat they see is a weakening economy, and this is also hurting the consumer. Do you think the same thing is going to happen in the U.S.? The Fed is going to wake up and say, okay, we still have high inflation. It's not near our 2% target rate, but we still see pain happening to the consumer, and therefore we got to start cutting rates.
Absolutely, and they have to, and I think the market yields will start to pull them downwards also. So we have to understand also that the Fed often will follow the market yields. So we will see that 2-year yields will start to decline very fast as we start to get going, as we get closer to the point where it's becoming very obvious to everybody that the economy is slowing and the recession is ahead. So yes, I think that is happening. And if you look at it, the interest payments for the consumers are just skyrocketing. They have skyrocketed. They have been moving up faster than anything we've seen over the last 70 years, at least for as long as I have data. Which means that we're seeing the consumer first. It's very simple. You have to pay your interest rates instead, because the interest rates are so high. So you pay interest payments then. And then you'll cut on your consumption, and when you cut on your consumption, then the businesses will have to not employ as many people, and then they'll start cutting. First, they'll probably take some of the open positions off, and then they'll try to see if they can make people work a little less. And then later the initial claims will start to come up, and then you'll see it also in the non-farm payroll. So there's a sequence to it, but that sequence is working perfectly now. We see it now with the demand. As I said, the most recent retail numbers doesn't look very good, and we see also that the unemployment is moving up because the companies are slowly starting to take action on this. And it's not like you are just seeing that immediately. This is a slow moving, or it's a super tanker turning, and it's like, again, how did you go bankrupt, and how did you see the recession coming? It's like, first it was gradually, and then it was all of a sudden. And that's the same thing we're going to see with the recession. I mean, it's going to be a slow moving turn, and then we're going to see all of a sudden, and then it's there. So the Fed will follow. They will start to see, and I hope that they see it. And as I said before, I think they are already very late. And I do not understand how they can even talk about I mean, the soft landing narrative is so naive that it's unbelievable.
Okay, so let's talk about this banking crisis. And you also made mention of the fact that you think we're going to have some sort of pension fund crisis. But why don't you provide some more detail on that? What exactly do you see unfolding?
There are different kinds of crises. There's not just one type of crisis. People have to understand that you can have deflationary crisis, and you can also have a crisis where inflation can become a problem. And then what we actually had when inflation went up was not really a crisis because the economy was still expanding, but you had inflation coming up into from 21 into 22. And the reason I was not paying, even though it went down a lot, the market, I have to give it that obviously, but it was because the business cycle was still strong at that time. But what we see now and what I'm expecting ahead is that the business cycle has rolled over in my metrics or in my model, and we're just starting to see that into the labor market. And the first part of that crisis will be a deflationary bust, which will be like what we saw during the 2008. So what we saw there will be again what we see here, and the Fed and every central banker of the world will of course jump on this. They'll not do it immediately. We also have to think that they are still scared of what they unleashed the last time. So if the market comes down a little, and they will probably just cut rates, and the rates are rather high now, so they'll cut rates, but they'll not come flooding the market with what is needed. And again, they are late. They are looking out the rear mirror in terms of where we're going. So there needs to be something. Deflation needs to stare them in the eyes before they actually will start to move. But the moment they do that, I think the difference this time around from what we saw in 2008 is that you will not see people will not jump on the new money that they will that they will, if you start to see that the mortgage loans are not, as expensive any longer because the rates are coming down, or that, your credit card debt is not so expensive to hold. You're not going to say, well, let's spend another $1,000 here, or let's buy a new house, or let's buy a new car or something, which is what you need in order for QE or monetary stimulus to actually work. If you don't do that, if the people are the consumers just say, well, let's stick to this money. Let's see, because actually we had inflation just a little while ago, and also the interest rates were high, and we were struggling a bit there, which they are right now. Well, if you have that kind of behavior, then you will not see that QE is going to create the bounce, or QE or whatever they're going to introduce in terms of monetary stimulus that they would be expecting, and that happened in 2008. I think this time around that's a different scenario we have, the different setup we have, because people are simply a little scared there. So what will happen what I see ahead of us is that yes, the Fed will react, but it's not and also we'll see the market reacting on the Fed coming in. So we'll have a bounce in the market at that point. So remember, that's after the first serious decline that I see, and after the top in this year. Well, then I think they're going to unleash a sort of a stagflation, and we were not far away from that in 21 to 22. If you saw that we were actually seeing, inflation was high, and if unemployment had been starting to come up at that point, and we have been at a different point in the business cycle, which we are now, well, then I don't think then we would have had another outcome. So the thing is that this time around, when they do this about when jumping in, and people will be waiting a bit, then the unemployment rate will not decline again, and you will see actually that this money will be in their banks, and they will start to circulate the financial industry, which means that you could see another speculative bubble arise. So this is a little further out, but what I'm seeing in short is a deflationary bust. Fed comes in, and then we unleash a stagflationary period, and that stagflationary period is going to be the worst part, because this is where the Fed has very limited tool, or any other central banks, or anything, any administration. Because if you pour more money on it or more stimulus on it, it'll just get worse. And if you don't, then you have the negative spiral. So it needs to work itself out, but there needs to be some structural changes to it. In the stagflationary situation, if I'm right on that, well, and you actually saw it in during, as I say again, 21 to 22, you saw pension funds actually having large losses, because inflation was moving up, i.e. bonds did not do well, and you also the equity market's not doing well, so it was in the bear market below 20% down. That is not a good situation for a lot of pension funds, because they will have to be either in bonds or in stocks, and this time is going to be bigger. So I think there are going to be a lot of losses there, and actually it's also part of the contractive wave thinking, so that into the final phase of the contractive winter, that you also have pension fund crisis, and that is what I see. I can see the drawings of that already. So I fear that part of the crisis. I have to say I'll be ready for it, but it's I think from a societal standpoint, it's not going to be a pleasant time.
So you have said that this pullback that we're going to see in the financial markets will be the worst that we've seen since 1929. And I believe back in 1929, the Dow pulled back somewhere around 80%. Do you see that same sort of pullback this time in the financial markets?
Yes, I do. I do. And that's why I'm saying this. Also, it's not just picked out of nowhere. I mean, I've worked with structures. I work with models that shows me that the kind of structure that we see in terms of how the market has been rallying is indicating that if we could actually drop to levels we haven't seen since it's not that long ago. But the 2020 bottom of Corona could be one place that we could bottom out. I think it actually goes lower. I think it could be all the way back to 2016 with those levels. And if you take a look at some of the markets, how fast they have been going up compared to where we and how much that would be in terms of the decline, we are close to that number. So when I say that, it may sound like wow, but that's ridiculous. But actually, what is ridiculous is the pace of which markets have been going up over the last few years. It's not the decline here. It's more that the very people have had the feeling that they've had wealth, but actually it's been due to money printing. And if that's now coming home to roost, then I think it's going to be a problem for a lot of people, and we'll simply see that the value of our portfolios will be coming down strongly. So the models that I work with tell us 2016 could be a bottom, and that would be in some markets it will be more than that. I think there are some small caps, it could be way more than that. There will be in the banking index, it'll be also as an 80% decline in in the banking index, which will indicate a big banking crisis as well. Many indications of that, and that's why I've said it also all along. It's not just a guess. It's like, well, actually the charts are showing me that these would structurally be the levels that we could drop to if we get that recession, and which it seems to be in the making.
And I want to get your views on gold now, because the last time we spoke, I believe gold was around $2,000 an ounce. Now it's somewhere between 2,300 to 2,400 an ounce. In this environment that you see, do you think gold will perform well, especially when you talk about a stagflation? Um, would gold not do well in that sort of environment?
Inflation will do fantastic, yes, but not in deflation. And I think gold is the outlier. If you compare gold to palladium, to platinum, to silver, to gold miners, gold is the only one that has been making a new all-time high in this cycle here. The rest of them have not. And I think what we're seeing is the speculation on gold is actually what has been driving it higher. So, and now everybody's speculating that, okay, then the rest of the pack will follow. I think it's the other way around. I still say in a deflation, I would not be holding gold. And that's what I've said all along. Has it moved higher? Yes, it has. And I give it that. But it's not the same as saying it's a fantastic asset to hold into a deflation, because people just need to think that, well, if the dollar starts to rise very strongly into a deflation, and you have debt that needs to be paid off, and this is what you see when you have credit crunches, which I think we'll have this time around again. Why would you want to hold gold? And it will be sold off to provide liquidity. But again, when the Fed moves in, and as you also rightly said, in a stagflationary environment, yes, then you would be holding gold. But then you'll have, gold could drop to, again, I could still see 1250 on gold. So I'm just saying, why hold it from 2,300 or whatever it is now to 1,200, 1,400, whatever it's going to drop to, in order to, well, then you can get in, but that would be rather a big drop, and there will be so many other things that you should be holding in that period, in the deflationary period. So people had the notion that, or the idea that you need to hold gold into a crisis. Well, actually, the reason you hold gold is because if you want liquidity, you can get liquidity from gold, and that is why gold is a safe haven, so to speak. But it's just there are different crises. In inflation, stagflation, 100%, and I expect gold to go up much faster. I mean, even the rally in gold over the last couple of years has been, muted. I mean, nothing compared to what we're going to see. I mean, when we start to see that real phase, that real bull market unfold, well, then it's going to be much faster. But that requires a rather big pullback first, as I see it.
And so I just want to clarify something. So if gold's trading around 2,300 to 2,400, where do you see it going on the upside before it collapses?
So I've said all along, I could see it. I mean, potentially it could have topped already, and I think there's some weakness in it right now. I've said that I could also see it because I still expect the dollar to come down, and even though there's not 100% correlation, inverse correlation between gold and dollar, I could still see, of course, that a weakening dollar would support gold. So I said I could see it to 2,700 and still coming down quite significantly, but I would not bet because again, also gold usually sniffs up the environment of what is coming a little before. So I think you could see that gold could also drop from here. So I would not again. I think it's the most speculative play actually to hold gold at this point than holding risk assets, because risk assets right now with liquidity coming in will be fantastic. But gold will start to see that the deflation environment may be just around the corner, and then you could see something quite different develop. And I think also if you look at the Bitcoin gold ratio, I think Bitcoin will outperform gold. I can't remember what the ratio I'm expecting, but it's a lot that we could see Bitcoin surpass or outperforming gold over the next let's say 3 months.
A friend of Wealthion, Steve Hanke, joined us this week and explained what is going on with the economy and inflation. He questioned whether or not anyone in government is concerned with the deficit and offered advice on what they can do to avoid a dollar crisis.
What's happening in the economy, sir? Where is inflation? We at Skybridge think the inflation numbers are lower than the Fed is suggesting. Do we have that wrong? Are we in a period of long-term inflation?
No, I think generally, broadly speaking, Anthony, you're correct. And the reason for that is that the money supply, broadly measured by M2, the broadest measure that the Fed has been falling and contracting since July of 2022. And it's actually contracted by almost 4% since July of 2022. That's only occurred 4 times in U.S. history. You have to go way back to 1948, 49 to find the last contraction, and then you go back. You got another one in 37, 38, and then of course the big kahuna 29, 33. That was a Great Depression, and then 1920, 1922. You had another contraction. So they're very, very unusual. We haven't had any in modern times, and they're always followed by economic slowdown and recession. Of course, the Great Depression was 29, 33 contraction. So the economy is going to slow down because money is the fuel that drives the economy, and with long leads and variable leads, after you get these changes in the money supply, then you get changes in asset prices, changes in economic activity, and changes in inflation. So what did we have? On the upside, we had the money supply skyrocketing, and in February of 2021, it was growing at 27% per annum. That's a record. It's never grown that fast. And we got inflation, exactly what we thought. Now it's contracting, and back to your point, the inflation has been kind of plateaued a little bit in here for the 4 months, but it's coming down. It's baked in the cake. John Greenwood and I think by the end of this year, it'll be down to 2.5% to 3%. So that's a kind of a long answer, but you got to get the money supply. It's all about the money supply.
Do we have anybody that is willing to do that, though?
I don't see anyone on the political scene that's willing to do that. And if you look at the history of fiscal control, if you have statutory changes that are put in place, new fiscal rules that try to slow things down, those tend to work for a little while, and then they break them. So the only way you really can do it, I think, is to have a constitutional convention under Article 5 of the Constitution and look specifically at how to change the Constitution that would require something like a Swiss debt break, like the Swiss do. They changed their Constitution, and now they must balance their budget, and the government expenditures can't grow any more rapidly than the rate of growth in the economy. So that's that. I think that's the only long-term solution, really.
If I talk to business leaders, no one cares. If I talk to the campaigns, I have friends on both campaigns, the Biden campaign and the Trump campaign, don't care. Not going to stop it. Not going to do anything about it. Don't care. why such apathy? You're concerned about it. I'm concerned about it. If I was in the government, I'd be pulling a 5-alarm fire. I'd be working on a 15-year deficit reduction plan. I'd be telling the American citizens how dangerous this is and how we're going to lose our dollar supremacy. You're now spending more in interest rate payments than we are in national defense, and that's only going to accelerate, sir. So what am I missing? Or is it, because there is also wisdom in crowds. Maybe I'm completely wrong. Listen, I've been humbled by life and markets, Professor, so I'm not here even pretending for a moment that I'm right. Am I missing something? Is the marketplace right, that the indifference is the right approach, or should there be some less indifference?
And you and I are in the same camp, obviously, on this on this score. These kinds of things aren't a problem until they sneak up and bite you in the rear end. It's that
Right.
It's that kind of problem. And as Herb Stein, who was the chairman of the President's Council of Economic Advisors under Nixon, once said, if something can't go on, it will stop. And this can't go on, and it will stop. And what people have to think about are those three options that I just mentioned to you. Are we going to squeeze government spending? Are we going to increase taxes, or direct taxes, or are we going to have more inflation tax? That's the only thing that can happen, and it will happen, by the way, because as Stein says, if something can't go on, it will stop.
Okay, so let me set the stage for you. It's 2030. We're spending $2 trillion in interest rate payments, $1.25 trillion in national defense, and we're upside down in our budget deficit by $2.5 trillion, and we're having a dollar crisis. People are shedding dollars internationally because they're worried about this upside down apple cart. What would the United States do in the event of a crisis like that, sir?
With those who occupy Washington, D.C. and got us into the hypothetical crisis that you just put forward, it's very hard to predict what they would do. My guess is they would probably panic and make a move that maybe would make the crisis even worse. So it's this is one thing in the markets. I mean, you're in the market every day, and the thing that amazes me is that the markets aren't pricing any of these kinds of things in at all. You and I are talking about the debt and the deficit, and the CBO says this isn't sustainable. We know the arithmetic just can't keep going like this. The markets just don't have anything priced in for that. The markets are not pricing any of these broad things in. For example, the proxy war the U.S. is engaged in with Russia right now in Ukraine, none of that's priced in. What's going on in the Middle East, none of that's priced in. They're just all these larger things that are kind of off beyond the horizon that bite you when they bite, but before biting, nothing is happening. None of that's priced in. No one's pricing in a bite.
Okay. What would you do, sir? Is there anything actionable, given everything that we're discussing? I always like asking our guests this. Is there something actionable that you would do today that would improve your portfolio?
The actionable in terms of fiscal policies simply way out of equilibrium, shall we say. It's not sustainable. So I would start doing something with it right now. And as I say, what I would do is be pushing for a constitutional convention and a change in the Constitution that imposed something like the Swiss debt break into the U.S. Constitution. That would fix the fiscal thing right away. The next thing I would do is get a chairman of the Federal Reserve that was in there paying attention to what was going on with the money supply. Somebody like Paul Volcker, who paid attention to the money supply. It's all about the money supply. The current chairman, Powell, is not even looking at the money supply. They don't even look at it. They've poo-pooed the thing. They said it doesn't matter. it doesn't count. So it's not in their models. It's not in any of their templates. They hardly even report on it. How many times do you see in the newspaper a headline of what just happened to the change in the money supply during the last month? You've got to look in some footnote, even in the Wall Street Journal, to find the number.
The petrodollar agreement with the Saudis, it looks like that they haven't re-upped that agreement. Some people say that that's a big deal. Other people say it's not that big of a deal. But, the BRIC countries, many of these countries are thinking about figuring out ways to trade in commodities away from the U.S. dollar. Our sanctions on our enemies have certainly created incentives for these people to do that. Are we at risk of losing our mantle of monetary leadership?
Well, for one thing, that petrodollar agreement, from what I can figure out, never existed. So this has been something that's been floating around on the social media. But as someone who's been studying currencies more or less for over 50 years, I'm not aware of that agreement. From what I can figure out, it never really existed. But be that as it may, what are the risks? Well, the risk, if you go back 2,500 years and look at all the currencies, the world economy for 2,500 years, there's always one dominant international currency. The US dollar happens to be the dominant international currency. There have only been 14, Anthony, in 2,500 years. So it's hard to knock the king off his throne. But how do you do that? When do challengers come in and knock a king off the throne? They come in with basically bad monetary management and bad economic policies of one sort or another. So let's look at the U.S. and the U.S. dollar. Right now, of course, it's unbelievably strong. It's been unbelievably strong for a couple of years. It's the old line, as a trader, you'll know this and appreciate it: buy dollars, wear diamonds. And so that's where we're at right now. So, but if you look at the social media, you've got basically the enemies of the United States who want to de-dollarize. So they're fanning the flames, saying all these weaponization of the dollar, sanctions, and so forth are going to cause the dollar to tank, and somebody else will take over. Well, I agree. Sanctions are a bad thing, and weaponization of the dollar is something that makes it more vulnerable, but something to keep your eye on. But at this point, we're certainly not in any tipping point zone. So you have, China and Russia, they talk a lot about de-dollarization and the fact that the dollar is history. And of course, all the crypto crowds, they put out basically the same propaganda. So you get a lot of chatter about de-dollarization. But the fact is, if you look even for central bank reserve buying, central banks are piling into the dollar now. They're actually increasing their dollar reserves. The percentage of their total portfolios that has been in dollars, it has gone down a little bit in the last 10 years. But one of the main reasons for that is that the Swiss were intervening tremendously to try to hold down the value of the Swiss franc, which kept ever appreciating. And they were doing that by doing what? They were buying euros. They were selling Swissy and buying euros. So that's probably the main factor. If you look in the aggregate reserves of all the central banks, that's the reason the dollar's role looks like it was sliding a little bit. It was mainly that Swiss intervention. Now they're actually coming back into the market and buying dollars.
If you were the Secretary of the Treasury, what would you do, if anything? Would you have no sanctions on any of our adversaries, or what would you do?
As a principle, I would deep six the sanctions. They're counterproductive. They hurt the United States more than they hurt the enemy. What do? They strengthen the enemy. You get a rally around the flag effect.
Right.
If you sanction somebody in a country or a country, everybody says, oh, those who are imposing sanctions on us, they're at war with us. They're our enemy. So they want to circle the wagons, rally around the flag. And that's why the history of sanctions since World War I have been a complete failure. There are almost no sanctions have ever accomplished their stated objectives. And by the way, I was involved in this once with President Trump's administration was considering putting financial sanctions on Hong Kong, as you remember. And
Yes.
Secretary Pompeo called me one Sunday afternoon and says, we're going to meet on Monday and decide on these financial sanctions against Hong Kong. And I was requested to get your opinion on it. So we talked for about 35 minutes. I was, of course, adamantly opposed. Pompeo was adamantly for. And ultimately, the next day, I got a message back from the White House that just basically said, "Hanke, you won. There won't be any sanctions on Hong Kong."
Yeah, well, it was a great move. And thank God for your contribution, because sometimes these things are reactionary and they don't really factor in all of the long-term consequences. So I before we go to the audience,
By the way, the Hong Kong thing is interesting in the sense that the Hong Kong dollar is issued by the Hong Kong Monetary Authority, which is a currency board, and it trades on a fixed exchange rate of 7.8 Hong Kong for $1 US, and it's backed 100% with US dollar reserves. So the Hong Kong dollar is in effect a clone of the US dollar. So if you put sanctions on Hong Kong, what would be financial sanctions? You'd basically be attacking the U.S. dollar. So it would have been stupidity, doing the same thing over and over again, expecting different results. It would have been a complete disaster.
Well said, sir.
When it comes to cars and how to make money with them, not many are as savvy as Aubrey Janik. She joined Wealthion to talk about dealers, how to buy a car, and how to make money with cars. She has a fleet of them and explains. So just, let's start generally. What the heck is going on with the car market? It seems to have changed since I started driving, and I'm not going to tell you how many years ago that is, but the car market has definitely changed in recent years.
Oh, yeah. I mean, it's changed, I would say, more in the last 4 to 5 years, and it probably had changed the prior 15 to 20 years. And it's just been a real night and day difference. And so kind of the long story short Cliff Notes version is that during the pandemic, due to a variety of factors, including, shortages, incentives, companies cutting back on production, there was not enough cars being produced for really kind of that 2020 to beginning of 2021 period of time. And as a result, that production shortage really came to a head in 2021, where, you heard about dealership lots being empty. People couldn't find cars. Cars were selling for a lot more than what they were worth. You could sell a used car for much higher than what you paid for it. And that really came to a head during that time in summer of 2021, specifically, almost exactly this same time in 2021. And it really continued up until about last year, where production just did not meet demand. And as a result, car prices were very, very high. And then in the last about year or so, maybe a little bit over a year, the car market has started to very slowly but surely level off. And now you are seeing higher inventory. I mean, inventory has increased. New car inventory specifically has increased 55% in May of 2024 compared to May of 2023. You're seeing these lower prices. But the problem is that dealerships really reacted to the lack of inventory a lot faster than they're reacting to the surplus of inventory. And so when in 2021, we saw prices skyrocket very quickly as a result of low inventory, and you're not seeing that dial switch back quite as quickly today. And so prices are still, I think, higher than they should be. Dealerships are still a bit unwilling to negotiate. It's very difficult to navigate the dealership process. And so we're really fighting the ramifications of what had happened back in 2021 through 2023.
I want to ask you about the car buying process. Now, it like you said, there's not a lot of negotiating. You seem to walk in and, like I said, I just bought a certified pre-owned. And when you walked in, they have an internet price that there's almost no negotiating on. You have to find, first of all, you have to find the perfect car. And then there's no negotiating on these cars anymore. So, they could have anybody selling a car because there's no salesmanship any longer.
Oh, I mean, I could write a book on this topic because it's something that
Please do.
I should. It's something that I put so much thought into because it's so annoying. I think that the car industry and specifically car sales have become, it was already truthfully kind of a bad industry, like a bit skeezy, and it's become just so much more so over the last couple of years, and it's horrible. And so you have like these discrepancies of when you go into a dealership, not only are they not willing to negotiate, they're not transparent on pricing. They are kind of giving you the runaround. So many dealerships are offering, these packages that are required. I bought a Tesla back in April and I ended up buying it on Facebook Marketplace used. But before I went to Facebook Marketplace, I went to a local dealership that had the exact trim I wanted. They had the price. I was willing to buy it right then and there. And we walk in and the guy puts me to his desk. I was with my husband and he's like, hey, before we go and show you the car, I want to let you know that we require all of our buyers to buy this $2,500 like premier package, which includes all of this crap. And I just got up and left. I was like, this is ridiculous. And I left and I told him like, you wasted my time. This is ridiculous. And then I ended up leaving and I ended up buying one on Facebook. And I think that the unfortunate reality is that because people are still buying cars and because automakers are still making great profit, they haven't felt the need to change their dealership practices. And I do think until, their bottom line and their sales are hurt by these shady practices, they're not going to change. And so they're still kind of sticking to this skeezy approach that they took in 2021 because they had the power that even though this dynamic is shifting, they're not shifting back to how things were.
Talk to me about new versus certified pre-owned versus used. Obviously, you buy used through Facebook Marketplace. Mm-hmm. I don't remember. I had a similar situation with an old car where I didn't trade it in. I actually sold it on my own because I felt like I would get more money. So and I did get more money than they were going to give me for the trade-in. So, but talk to me about new versus used versus certified pre-owned. I was looking for a certified pre-owned only because I felt like it had a little bit more of a warranty. I bought a 2020 Honda Civic and they give you, it only has, I think 17,000 miles on it. So you get that 100,000 mile guarantee. Yeah. And so, and actually the one that I had bought for my older son had an air conditioning leak that they fixed for free because it was CPO. So talk to me about the difference between those things.
So the big difference between CPO and I guess I'll go in order of like new, CPO, and then used. So new is obviously going to be the most expensive. And I think that there's always this, wrong connotation with new cars where like, oh, we want a new car because it's going to be more reliable. It's going like, we want reliability. And while I do think that new cars are inherently probably going to be a little bit more reliable right out of the gate, just because they've never been used before, I think that this idea that like, you can't get a reliable car that's used is just it's very false. And a lot of people, I think, get that wrong, especially non-car people. Like you hear oftentimes people say it of like, oh, well, my family gets rid of a car every 4 or 5 years because of reliability. And that just isn't the case. Up until I got my Tesla, my daily driver was a 97 4Runner that was and still is very bulletproof. So it all depends on the car and the maintenance. But with new cars, you have that aspect of, warranty, you have the reliability that people associate with it, but you have the massive depreciation that you're going to have as a result of that. And for that reason, I think in 98% of cases, getting a new car just simply doesn't financially make sense. Like you can put your wants into it and maybe justify it that way. But whenever we look at the numbers of the situation, new cars very, very rarely make sense. I think one of the exceptions, and there are a handful, but one of them would be like a Toyota 4Runner. Toyota 4Runners, they don't depreciate at all, really. They hold their value extremely well. If you really wanted a 4Runner, it could make sense to buy it new. But then we go into, the CPO and the used, which is, I think, the best case scenario is you buy a 3-year-old car that is already depreciated. You had somebody else absorb that cost and you come in and own it, and you can do so in a really, I think, financially sound manner. Now, the difference between CPO oftentimes is and it depends a little bit on manufacturer, but it comes down to the warranties that's offered, but then also like the reconditioning. And so with CPO, a car has to meet a certain set of standards for it to be certified pre-owned. And automakers actually kind of changed this a bit during the pandemic. Honda was one who kind of notoriously expanded their CPO offering. I don't actually know if they like limited it back. I need to check into that. But they made it so that I believe it might have been 10 years. Don't hold me to those exact numbers, but they changed their CPO to be significantly older than it was before as a way to accommodate to the changing car market. And so I do think that CPO in some ways has maybe lost its meaning a bit, just because of the fact that they are accepting older cars. And I think that this reconditioning that they say can be a little bit either misleading or maybe just not as important as they make it seem. I think especially with third-party warranties in account, like you can get warranty even on a regular used car. So, I think that CPO has merit for sure. I think that if you aren't a car person, going CPO can maybe provide you with that extra bit of just confidence going into the deal. But I personally wouldn't hesitate getting a non-CPO car, and I wouldn't advise somebody to not buy a non-CPO car either. I think that it just kind of depends on the deal.
All right, so now let's talk about the cash in your pocket and lease versus finance versus pay cash.
Yeah, so I think I'm very anti-lease. Just in general, I think that in today's market, leasing, it just very rarely makes a lot of sense. I understand that there is a tax play with leasing that kind of adds a whole another dimension to leasing that can possibly make it make sense. But I just think for leasing, you're putting so much money into the lease, and then at the end of the day, you don't really have anything to show for it. And so for me, leasing is, in the majority of cases, it just doesn't make sense. And, there are exceptions like the EV tax credit can make sense with leasing businesses, but we'll kind of negate that. I think for most people, that leasing just doesn't make sense financially. Whenever it comes to financing and paying cash, I think it comes down to just like the math aspect of it, which is, can you get a low enough interest rate to justify financing that? Or would the term be short enough to where even if it was a higher interest rate, it wouldn't be a big deal? And so and I also think long-term goals also makes an impact, is like, what do you plan on doing in the next year with your money? Like, for example, whenever I bought my Tesla, I bought it in cash predominantly or almost solely because of the fact that I knew I wanted to buy a rental property at some point this year. And I knew that if I financed it, it would be a negative on my credit. And I didn't want to risk that. But if you have no plans to make any large purchases and you can get a solid rate, I think financing it is fine. I also think that a big portion of the equation, which I think a lot of people don't talk about, is the value retention of that car. If you're buying a 2024 Audi that's brand new and you're financing it, I think that's a terrible financial decision because it's going to lose value. It's probably going to be a bit of a high rate, especially in this market. It's going to be a high monthly payment. But if you're financing, say, maybe a Toyota RAV4, or even like BMWs have been holding their value fairly decently, you finance something that isn't going to depreciate the same rate, even if it's for a longer term, I think that's a much better play than financing one that's going to depreciate. So the depreciation play also comes into account with financing, which I think a lot of people forget.
So how many cars do you own right now?
33 total.
All right. Talk to me about that. I know you have a unique way of making some money. And look, I've rented cars and I've seen Turo as one of the options.
Yeah.
I have not used it yet, so I'll be honest about that, but I know it's out there. So talk to me about how that works. And 33 vehicles, I think I have 3 now, and I only drive one of them at a time. Obviously, my son has the other one, and one sits in a garage that I only use during the summertime. So talk to me about how you make money with Turo.
Yeah, so my husband and I have a Turo fleet. And for people who aren't familiar with Turo, it's sort of like an Airbnb, but for cars. And so you rent out cars to people, they pay you, and then there's like a slew of other things that go along with it, but that's like a very summarized version. And so we own a fleet of, and amongst those 33 cars are also our personal cars as well. And so I think 29 is actually Turo cars. But the way that it works is you just you have these vehicles and you rent them out. And if you've ever looked on Turo, you probably see that there's a lot of different types of cars. You have people who kind of get the new sexy car, like the Cybertruck is a big one right now. But then my business model is sort of the exact opposite, which is normal everyday cars. And so I go after, Mazdas, Hondas, a lot of Toyotas, Fords. And my kind of whole play is really kind of diving into what I've spoken about on this discussion is, going after cars that have already depreciated, buying them in cash, renting them out, and then either selling them or they eventually get totaled and kind of rinsing and repeating that. And I've been doing that since 2017.
And how do you make money with that? Obviously, is there a Turo site? How did you get it set up?
Yeah, so you can make money a few different ways, but I would say the kind of main ways is like you do go on Turo.com, so it's just like Airbnb in the sense that like you go there, you set up a profile and you list a car. And then from there you have a daily rate. And so you set that daily rate based off of the car that you're renting as well as market demand. And different markets will have different prices for different cars. And so you list it and then people rent it. And so you get money from like the daily rate. You can also do extras. And so, for example, in my cars, we offer children's car seats. And so that's like a fee that you can add, but you could do like beach equipment. I think bikes is an option. There's like a handful of like a catalog that you can choose from. And then there's things like, you get a convenience fee for gas, which is $10, but it does add up. And then a big area where you can potentially make money is also like off of the play of buying the car. And so that's one thing that I talk about a lot on my channel is that with Turo, you not only make money off of the front end, so like renting out the cars, but if you buy the cars at the right price, you can also make money off of the car itself, either, if it gets totaled or if it ends up needing to be sold. And so if you buy cars that already have depreciated, you buy them at below market value, you can then make a pretty good profit like off of that vehicle, sort of as if you're flipping a car type of thing.
Brett Rentmeester from our partner RIA Windrock stopped by Wealthion to explain all about central bank digital currency versus cryptocurrency, how the government could implement the digital currency. So, central bank digital currencies. Now, look, we all walk around with a little bit of cash in our pocket, and that's what we consider currency. But like you said in the article, when the country needs more money, they don't print it. They actually make ledger entries and make, here's the money. So explain to us exactly what a central bank digital currency would be.
Yeah, it's a great question. And this is a key to this informed consent concept here, which is what it's being billed as. Let's start with that is, this digital money, kind of similar to cryptocurrencies that people are getting used to, and it'll be easy to transact in and cheap. Great. Let's all use it. It'll be on your mobile phone. Okay. However, we already have, as you pointed out, digital money. Most of the money out there is not $100 bills changing hands. It's digits on a ledger at a bank going from one account to another. So it's a little misleading, in my opinion, to just say it's an improvement in digital money. It's not. Really, what I would say is CBDCs are equal to programmable money, something that's a little more sinister. They're handed out, but they have technology that allows a lot of controls to be put on them. And if I could just share one quote, this was from a number of years ago, I believe 2020. So some time ago, central banks were working on this. You had Augustine Carstens, who was the Director General of the Bank of International Settlements, which is commonly thought of the central bank of central banks, basically say this about central bank digital currencies. The quote was, "Central banks will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability." It's referring to CBDCs. And also, we will have the technology to enforce that. So when I hear that, two things jump out: absolute control and technology to enforce. Well, listen, CBDCs aren't inherently bad, but they do give complete trackability, transparency, which can be good, but in the wrong hands, the idea of complete transparency plus control can be a problem. So the real question for people is, do you trust the current slate of bankers and politicians today? And if you do wholeheartedly, then maybe it's not a bad thing. Otherwise, I think there's some reason for real caution.
It seems to me we live in a world where we make mistakes, where there's lawsuits, or you owe the government some money. If we go to a digital currency, it's going to make it a lot easier for the banks to just lock you up without a trial. Almost, they can put, it seems, if it's a central bank digital currency, they kind of put a padlock on your account and say, okay, you can't spend any more money until we figure this out. That doesn't happen that way right now because they can't, unless you've gone through a process and you've ignored them long enough, they can't really put a lien on your bank accounts. But this would make it a lot easier for them to make mistakes even, and in essence, lock people out of their money by mistake.
Yeah, absolutely. And listen, we've seen some more recent real life cases where they are trying to lock people out of their money. It happened with in Canada a bit with the truckers' protests and certain people that funded that, even people that might have made a $20 contribution, trying to lock people out of accounts. We think of China maybe as the front edge of this, where it's not just your money. It's some kind of social credit score working against you. So, all these things kind of come together into a dangerous mix where technology is now caught up to a point where these things are possible. Sounds very dystopian and 1984-ish, but the reality is the tools are there to make a reality like that possible if we let it.
Why would central banks explore this instead of, which is, it's transparent to a point, instead of exploring a crypto type currency where it's deregulated, it's person to person. Look, if I wanted to buy something from you, we transact. It goes in a blockchain. End of story. There's a record of it. You can go back. But where it just seems like why a little bit more complicated. But why would central banks be exploring this instead of something like crypto?
Yeah, I'm glad you brought it up, because the first point would be it's a mistake to think of CBDCs as crypto because they're almost the polar opposites. So on one hand, CBDCs have control. They've got monitoring, centralized power controlling everything, right? The premise of cryptocurrencies, by and large, is decentralized. We don't need a middleman. We don't need a government sitting in the middle anymore. We've got a self-executing program maintained by a user community. And that's a real risk to power structures. Because historically, last couple of hundred years, we always needed this middleman to develop trust between transacting parties. Cryptocurrencies changes that because the technology itself doesn't require a trust between you and I. I know that if I send crypto, you're going to receive it, and there's just an element of it that doesn't require a bank in the middle. So I think it's a power grab in the sense that I think all of these governments globally, and 98% of the central banks are working on a CBDC. So this not, again, it's not a fringe idea. They all have a similar backdrop, which is they're slowly losing control a little bit of this cryptocurrency phenomena. But also, I think behind the scenes, they know that the fiat system is in trouble, and this debt-based economy we've built can only go so far. So just in the US alone, I was just looking on usdebtclock.org. Of course, we all know we have about $35 trillion of official debt, but there's all these unofficial things that just don't get added to that. Unfunded pensions and liabilities, et cetera. And that, by that site's measure, is greater than 200 trillion. So I think at some point they know, hey, this thing's going to go out of control and we need some solution out of the ashes. And this is going to be their mechanism.
Let's go to the other side where we're not controlled, and explain to us the cryptocurrency side, how that would work. And I know that when you have a cryptocurrency, it's, I guess, what the market would bear, right? When it comes to how much it costs.
Yeah, certainly for things like Bitcoin, those type of examples we used. For the stable coins, this whole new area, those are trying to create a little more of a stability. But again, I think, the primary differences include these are decentralized but transparent. The other one's transparent, but it gives one power the power to control all the levers. This is transparent, so everybody trusts it, but no one player can compromise somebody else's cryptocurrency, right? And so I think, listen, this is still early stages, and we're just seeing within the last year certain companies use cryptocurrencies. We're seeing countries like El Salvador and potentially Argentina starting to use them. In fact, some of the biggest adoption of cryptocurrencies is in countries that have blown up their currencies. And it makes sense, right? If you're used to high inflation or a currency massively devaluing, and you have a choice of owning whatever that is relative to something with limited supply, people are eventually going to get the hint and move into things that they think will hold value. And so that's the other key fundamental thing. I mean, just using Bitcoin as an example, 21 million will be the maximum supply ever. And again, central bank digital currencies, the sky's the limit, kind of like what we have today. But it does seem like, because the debts are so high today, if we go to that kind of system, first they have to right-size the debts. There has to be a crisis and some kind of reset where they give you less. Somebody's got to pay, a price or give up something for them to reset a system to move forward. So that's the fear, right? Will that come to fruition? We don't know. We're all part of this story. But I think the more people can educate themselves about what central bank digital currencies are, and with a healthy skepticism and an understanding of other things they might be able to do to not put themselves in a position to be totally reliant on it, the better we'll all be.
Is there something we're missing with CBDCs? Is there a positive that I'm not seeing? Is you've obviously given this a lot of thought. You've done your research. You know how this could work if implemented. I just seem to be missing something or a positive here.
Well, again, it's from whose perspective are we looking at it from? From a government perspective, the positive might be, hey, Andrew owes taxes, I'm just going to take it out of his account. Or from a central bank perspective, it could be, hey, we're trying to get the inflation rate up. Let's just hand out a bunch of money and tell people they have to spend it in the next week, or it disappears from their account, right? It gives them this feeling like they're controlling the levers. But much like this Wizard of Oz analogy that one of my colleagues wrote about recently in a different context, it's the man behind the curtain. For the individuals, is it any step up from Venmo or sending cryptocurrencies? I can't see it. I mean, yes, we're going to move more digital in the world, but there's a difference between becoming digital and creating a programmable money that people can, restrict you from, take away from you, or put an agenda on. And I think that's where the problem lies.
Finally, next week on the trading floor featured Justin Nugent of Market Rebellion. In an off-script moment, Justin decided to go with 2 winners this previous week instead of one of each. Take a look to see who he picked and how he did. Your pick for last week, which was the S&P 500 ETF, which you said was a longer-term bet, still went up this week.
Yeah. Oh, man. I just want to thank you, Wealthion and Andrew and Market Rebellion, for allowing me this platform to make a prediction that literally nobody else is was a fan of here. Now it's starting to look like we could get even higher than that, right? 600, we're still keeping it. 600 for the SPY, S&P 500, 6,000. We're halfway through the year. We've already done, 13, 14%. And first half isn't even done. From here, we need another maybe 10.6%, I believe, from where we're trading right now. Right. That equates to about 26% gained throughout this year, which if you look at 2023, we gained a little more than 26%. If you look at 2021, we gained a little more than 28%. If you look at 2019, we gained a little more than 31%, all respective to the SPY. So for those out there who thought 600, that's crazy. It's not actually so crazy after all for a bull market year.
All right, so let's recap. NVIDIA, you think that's what your winner for the week, and we went with a second winner, which was also AI, which was C3 AI, a software company, a software artificial intelligence company, and the unusual options activity is Netflix. So those 3 stocks you think are going to do pretty well over the next week.
Yeah, the theme here is stick with what's working, look at the data, look at the chart. Stocks are going up. What stocks are doing the best? It's growthy, high beta, AI-related tech stocks. And it makes perfect sense. It's looking a lot more bullish out here than it has throughout the rest of the year. And I'm here for it.
Oh, I will tell you that a few weeks ago when we spoke, you did hype NVIDIA. I did get in. I'm up about 11% so far. So, and I have 10 times as many shares. So, it's all working. It's not the only trade I've made some money on. So, you need to listen to Justin. You need to listen to Market Rebellion, and you need to, just do your own research as well. Make sure that you're comfortable with whatever it is that you're doing. So, I know that there is on Justin. I know that there is on your advice money to be made here, but obviously you want people to be comfortable and do their own research.
Always. It's the most important thing. What I always say is that if you're not familiar, especially with options, open up a paper trading account. It's the only way that you can actually say, hey, there's zero risk in what I'm doing. If you're paper trading, that means that you're not using your real money, but you're using the real stock figures. You can find those on Thinkorswim or a variety of other platforms. And just try paper trading, see how it goes, see how theta goes, see how the trades go, and find out what you're comfortable with in terms of risk, and try and trade like you actually would trade in real life. I think that's the best way to really learn what you're comfortable with, and also to see the power of some of these trade ideas.
You can also head on over to marketrebellion.com. They have a bunch of educational videos that you can watch that if you're looking to get into options, it's a great place to start.
Absolutely.
Thank you for watching this week's recap. Don't forget to head over to wealthion.com for a free no-obligation portfolio review with one of our registered investment advisors. And please follow us on social media for the latest news and information to help you invest wisely. If you haven't done so already, please make sure to like and subscribe to our channel, and don't forget to turn on notifications so that you never miss a video. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and are looking for more ways to keep growing your investments, watch this video next.